This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Stocks pounded. The Dow plunges more than 650 points, one of the biggest point declines for the blue chip index ever.
Inflation threat. Jobs are being created. Wages are growing. But good news on Main Street is bad news on Wall Street.
Rising rates as yields go up. How should you invest? Our market monitor has some advice. Those stories and more tonight on Nightly Business Report for Friday, February 2nd.
Good evening, everyone, and welcome. So sit back, relax, enjoy the flight, because the day's turbulence is over, at least for now, and what a day it was. For the first time in a very long time, stocks hit some serious air pockets. It was, to be blunt, the worst sell-off in years, fueled by concerns about rising interest rates and some nitpicking about selected corporate profit reports. The Dow Jones Industrial Average plunged 665 points to 25,520, or about 2.5%. The Nasdaq dropped 145, and the S&P 500 dipped 59. All 30 of the Dow components were lower, a day of red numbers. And of all the 500 stocks in the S&P 500, only a handful were in the green and higher. Today concluded the worst week for the major averages since 2016.
And the selling started with the release of the January jobs report. Employers added 200,000 jobs last month, which was more than expected. The unemployment rate remained steady at 4.1%, and wage growth accelerated. Average hourly earnings jumped 2.9% from a year earlier, the strongest year-over-year gain since 2009. Investors are concerned, however, that could trigger higher inflation, and so bond yields rose and stocks fell. Bob Pisani has more on the sell-off from the New York Stock Exchange.
Stocks gave up about one-third of January's strong gains. The Dow and the S&P 500 both suffered their worst week in 2 years. Volatility spiked to a 15-month high, and trading volume pretty substantial. Now, we're halfway through earnings season, and it's been a great quarter. Earnings are up nearly 14% from the same time a year ago, and until now, they've kept going up. But rising interest rates are clearly posing a threat to the stock market. Today's January jobs report showed that wages grew almost 3% year over year. That's the strongest since 2009. That's good news for American workers, but it has investors on edge because a pickup in inflation could mean the Federal Reserve raises rates 4 times this year instead of 3. That would be a problem. We saw stocks trade in tandem with bonds throughout the day, and when the 10-year hit 2.85%, going up, the market hit its initial lows in the morning. Then the GOP released a controversial memo from the FBI around noon, adding to the nervousness, and the S&P fell another 7 points in the middle of the day. Now, keep in mind, the major averages are still hovering right around where they were about 2 weeks ago and down 4% from their all-time highs. That's hardly a correction, but it does have investors wondering if we're in for an even steeper drop in the coming weeks. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Well, a 600-point-plus drop on the Dow has only happened 8 other times. Today's drop in percentage terms was about 2.5%. For perspective, that's a lot less than past 600-point drops. As you can see, the last big point decline, that big, was 2016, when the Dow was trading at 17,000. That resulted in a 3% fall. The sell-offs in 2008 resulted in declines of around 7%. That's because the Dow was trading at levels much lower than it was today. All right, now back to that jobs report that keyed so much of what happened today. Hampton Pearson takes a closer look at America's strengthening labor market.
January saw a rebound in hiring, with worker pay rising at the fastest rate since the end of the recession 8 years ago. Average hourly earnings are up 2.9% in the last 12 months to just under $27 an hour. Economists say pay hikes stemming from Republican tax cuts, plus increases in the minimum wage in 18 states, were key factors.
The employment figures are kind of right where they've always been. What we've been waiting for is wage growth. And today we saw wage growth that's healthy, that's trending in the right direction.
Job growth was broad-based. Construction led the way, adding 36,000 new workers to meet demands for new housing and remodeling. Healthcare continues to be an engine of job growth, with 26,000 new workers. There were 23,000 high-wage new hires at business service firms needing engineers and accountants. Both small and large businesses are competing for a shrinking pool of workers. For Earth Fare, which runs a chain of 45 natural organic food stores in 10 states, business is booming. It's now hiring 1,300 new employees to work in the 10 new stores opening this year. Its CEO says competition for qualified workers often pivots on pay and benefits.
We are constantly benchmarking and making sure that we have the most competitive remuneration for our team members, depending on which area of the business that they work. And there has been some upward dynamic to that very recently.
Higher wages may be good news on Main Street, but markets see inflation red flags and concerns the Federal Reserve may raise key short-term interest rates at a faster pace in the coming months.
This kind of wage growth could spook the Fed and add another rate increase this year. That said, what we really haven't seen in this economy is wage growth mapping onto price growth.
The Fed's going to be very patient is the main point. I think they're going to continue to let the economy grow. We're seeing global growth, of course.
That pickup in wages, while long overdue for workers in the coming months, will test the patience of both the Fed and the markets. For Nightly Business Report, I'm Hampton Pearson in Washington.
So let's dig a little bit deeper into the January jobs report and also talk about why we saw such a dramatic sell-off in stocks today. Joining us to talk about the jobs report is Jim O'Sullivan, chief U.S. economist at High Frequency Economics. And here to tell us what's going on in the stock market is Nancy Tengler, chief investment officer at Heartland Financial. Welcome to you both.
Thank you.
You know, Nancy, I think I'm going to start with you. What did the market tell you today, or what is it trying to tell us?
Hi, Sue. Thanks so much for having me. Listen, none of us like this, but we know we need it. Think of it as a garden. You need to prune back so you can clear out the excess and get the growth you need going forward. The stock market got a little bit ahead of earnings. We had been talking about a correction as early as late July. We thought we needed to see one. We've gone 16 months without a correction. That's probably the longest period in history. And markets just don't go straight up. And so it may take a little bit of time. We may get an additional sell-off in the early part of next week. And as an investor, I think that's good news because it allows you to go in at lower prices and buy the high-quality companies that have delivered 80% of companies have beat their estimates from an earnings standpoint. That's unprecedented in my career.
Jim O'Sullivan, there is a curious kind of Alice in Wonderland quality to what happened today. We've been waiting a long time for wage growth to pick up in this country, and today we got an indication that it did, up 2.9%. That's great for American workers. How worrisome is wage growth that robust, or is it an unmitigated good thing?
Well, Tyler, certainly 2.9% or so on wages is not a problem. And of course, it's not just the average hourly earnings number, but the employment cost index number earlier this week showed a 2.8% increase, and whereas that number a year ago was running 2.3. So the point I think here more is that there is acceleration underway, and the message then is that the unemployment rate is low enough to start putting upward pressure on wages and probably inflation as well. So certainly if you were to stop at these rates of change, you throw in even 1% productivity growth, and you've got 3% wage gains, and that's a basically 2% per year unit labor cost number, which is consistent with the Fed's goal of 2% over time. But I think the issue here that's being raised is employment growth at even 175,000 a month is more than strong enough to keep the unemployment rate coming down. So I think the message to the Fed here is, yes, inflation is not a real problem at this point, but they've got to look ahead, and they've got to stop the downtrend in the unemployment rate. And to do that, they've got to normalize monetary policy.
Nancy, if you had money to put to work and you had the stomach to do it as an individual investor, where would you be looking to add to the market positions that you hold next week?
Well, see, we will be putting some money to work next week. One of the areas that we like a lot is, or one of the stocks is Federal Express. This is a company that benefits from e-commerce and has already done all the capital investment to improve their productivity. So we like companies that benefit from technology and can show sustainable growth. It also put some money to work in Verizon as a defensive play company with a high dividend yield that grows over time and is in a pretty low valuation level by historical standards. And then I can't believe I'm saying this, but I actually am going to take a fresh look at Apple. We had been selling into the strength last year, and I thought the earnings report wasn't terrible. Average selling prices went up. So we're going to do a little more work, and that might be an area where we'll add to some of our holdings next week.
Jim, you said the phrase normalize interest rates. That, I think, is econo-speak for raising interest rates. How many times do you think the Fed will raise interest rates over the next year, year and a half? How high will they go, and what will it mean for bondholders, for mortgage folks, for people who have home equity lines?
Well, in my own forecast at High Frequency Economics, I've got them going once a quarter. So 100 basis points in the next year, 150 basis points in the next year and a half. And if that's the case, that's a bit more than markets are pricing in. And in turn, I would expect bond yields to keep on rising. So certainly the 10-year has jumped from 240 to 280 basically so far this year. I mean, I would certainly see it going above 3% and potentially even to 3.5% by the end of next year. And mortgage rates would tend to go up as well. So they're still pretty low levels historically, but there is obviously a lot of room here for rates to go up.
Well, we will see. Thank you both so much for joining us. It's going to be an interesting week ahead. Jim O'Sullivan with High Frequency Economics, Nancy Tangler with Heartland Financial. Merck reported a mixed quarter. The Dow component reported profit that topped analysts' expectations thanks to a lower tax bill, but sales for the quarter were not as strong as expected in light of increased competition for some of its products. Merck, along with the rest of the market, fell today. Merck was down 2%.
ExxonMobil and Chevron, the country's two biggest oil companies, reported profits that missed expectations, despite a climb in crude prices in the most recent quarter. Now, Exxon's drilling business in the U.S. continues to struggle, losing money for the 12th consecutive quarter. Each of those stocks fell 5% or more in trading today. The two worst performing stocks, by the way, in the Dow. Jackie DeAngelis has more on big oil's soggy results.
Even with crude oil over $60 a barrel, big oil is still struggling. Those higher prices were unable to offset weakness overseas for Exxon and Chevron. Their earnings misses are troubling. Energy was an underperformer last year. The market thought this year would be different because oil prices are on the rise, but that may not be enough by itself. On the bright side, both companies saw benefits from the new tax law. Exxon is planning to increase its spending to $50 billion over the next 5 years. That would bring its U.S. spending to levels not seen since oil was around $100 a barrel. On the flip side, rival ConocoPhillips benefited from its strategy to cut debt. It also was more conservative with production increases, attempting instead to focus on margins and returns for shareholders. But Exxon and Chevron could continue to benefit from higher prices. Just this week, Goldman Sachs raised its oil price forecasts. While the road to recovery may be slow, some feel there could be a light at the end of the tunnel. For Nightly Business Report, I'm Jackie DeAngelis.
It is time to take a look at some of today's upgrades and downgrades. Apple's rating was cut to market perform from outperform at Bernstein following the company's earnings release. The firm says demand for the iPhone X slowed dramatically since December. The price target dropped to $170 from $195. Shares fell 4% to $160.50, pushing the stock into correction territory, now 10% below its all-time high. Google's parent Alphabet saw its rating lowered to hold from buy. The firm cites longer-term concerns, including Amazon, Google's cloud market share, and regulatory risk. The price target remains at $1,150. Shares fell 5% to $1,119.
HP taken down a notch to a neutral from buy at Mizuho. The firm cites limited upside to earnings over the near term. The price target stays right where it is, $23. Shares fell 3.5% to $22.48. Teva Pharmaceuticals downgraded to sell from neutral at BTIG. The firm sees continued declines in the U.S. generic drug market and higher borrowing costs. Price target now $17. The stock was off nearly 3% at $20.57.
Still ahead tonight, Market Monitor, the stocks you may want to buy in a rising rate environment. But first, a look at some of the biggest decliners in trading today. On a day when investors were worried about rising interest rates, a Federal Reserve official appeared to downplay those concerns. San Francisco's Fed President John Williams said he thinks the Fed should stick to its plan of gradual interest rate hikes this year. Some said that implied that he believes the central bank should not overreact to a strengthening economic outlook.
Sprint posts a surprise profit, and that's where we begin tonight's market focus. The telecom reported earnings and sales that beat expectations as the recent tax cuts and an uptick in new subscribers helped results. Sprint is also raising its free cash flow and operating income forecast for the 2017 fiscal year. Sprint shares rose 5% to $5.36. Honda Motors upped its profit forecast for the year because of strong sales in China. The automaker said its Asia market was the only region that saw sales growth during the quarter. In fact, demand was so strong that Honda expects that region now to become its largest market, a designation the U.S. currently holds. Profits during the period also beat expectations. Honda up nearly 3% on this down day to $36.16. Estee Lauder said there was strong demand for its newly added brands during the holidays. Robust sales for its Too Faced, that's my favorite, and Becca products helped Estee Lauder top sales expectations, also raise guidance for the full year. Lauder shares off a fraction to $134.39.
Operating income surged in the latest quarter at Sony, thanks in part to strong sales of its PlayStation video game console. The strong results prompted the company to raise its earnings guidance for the year. Sony also announced that its CEO will step down in April and the current CFO will take over. Shares rose almost 6% to $51.99. Drug maker AstraZeneca said it has entered into partnerships with Chinese tech giants Alibaba and Tencent in a move that will expand its presence in China. AstraZeneca said the deals will focus on artificial intelligence to help with patient treatments and also combating counterfeit drug sales. AstraZeneca shares were up 2% to $35.90. And OSI Systems, which makes X-ray machines and metal detectors, said it's being investigated by the Securities and Exchange Commission regarding its compliance with the Foreign Corrupt Practices Act. The investigation was prompted by a report by a short seller who alleged that OSI used bribery tactics to win foreign contracts. Separately, the company reported earnings and sales that grew, but the shares plunged. They were down 18% to $54.60.
Tonight's Market Monitor has 3 picks she says will do very well in a rising interest rate environment. Last time she was on in July, she picked Nutanix, which is up 62%. JP Morgan Chase up 23%. The iShares NASDAQ Biotech Index up 8%, and Alexion Pharmaceuticals 4% higher. Marianne Montaigne is with us tonight. She's a portfolio manager at Gradient Investments. Marianne, welcome back. Let's get a quick thought, if we might, on this big 665-point decline on the Dow today. How nervous should we be, or not nervous at all?
Yeah, I don't think we should be all that nervous given the gains that we had in January. You know, we've been calling for a pullback in the market because that's a normal thing for probably the last 5 months, and it's finally here. I don't think that the data that came out today supports this kind of decline in the marketplace, but people are taking some profits and giving us some buying opportunities.
Well, speaking of buying opportunities, let's get to your stock picks. The first is Pinnacle Financial Partners. It's about a $5 billion market cap. Why do you like it?
Right. This is a bank based in Nashville, which is it's one of the top growing metropolitan areas in the entire country. The growth just doesn't stop. And they've been growing their loans at about a 10% rate. Well, that compares to more like a 3 or 4% rate across the rest of the country. We think that the tax reform, accelerated depreciation, more expensing on the part of the companies will only accelerate that rate of growth. But recently, they kind of stumbled with an acquisition in the Carolinas and Virginia, and that's given us a buying opportunity here. So we think we can, we've owned this before. We think we can make another 15 to 20% on Pinnacle.
Air Lease Corp is in the aircraft leasing business, as its name suggests. Why is this a good play if rates rise?
Well, I think the stock hasn't risen as much as it should have based on fears of rising interest rates. And this is a company that's a specialty banking, lending company. They always take their cost of capital plus a spread. And when rates are rising, that spread is higher dollars. So, they're just matching their cost of capital plus the spread. And they're participating in that whole arena of rising international travel. So about 2/3 of their business is outside the U.S. About 46% is in Asia alone, where people are flying more than they ever have before. So we think it's a great business. The company is only selling at 1 time its growth rate and about a 35% discount to the market. So we think this is another probably 20% upside to the company.
All right. And then quickly, SunTrust Bank, another bank here in the Southeast region.
Right. So again, the Southeast is an area of superior growth versus the rest of the country. We think the tax reform will only assist their loan growth acceleration. The management has been very cautious about upcoming rate hikes, thinking there'll be only 2. We really don't know. The Federal Reserve is going to be completely different down the road as Trump has 3 more appointments on the board, and we have the new chair that just came in. So 2, 4, whichever the rate hikes would be, it's going to help all the banks. But we think this one's been conservative. They pay a 2.4% dividend yield, the only one of these 3 stocks that pays a dividend. And we're expecting a nice bump, maybe 10 to 15% in the dividend this summer.
That would be a nice bump. Marianne Montaigne with Gradient Investments. Have fun with the Super Bowl this weekend in your town of Minneapolis.
Oh, it's the bold north up here.
You're going to read more about Marianne's bold stock picks on our website, nbr.com. Thanks again. And still ahead, drilling down, you're going to meet the entrepreneur who had the bright idea to heat homes by digging a hole. Using the Earth's heat to heat and cool your home is energy efficient, but installing a geothermal system means drilling down hundreds of feet, and that costs a lot. Less than 1% of U.S. homes use geothermal systems, which can cost $50 grand. That's why one young entrepreneur got what she hopes will be the bright idea to make them more affordable. Becky Meyer's new geothermal heating and cooling system is quietly shaking up her own home economics.
It's kind of nice, no more oil bills.
There was a tank.
Last September, Meyer and partner Bob Connors stopped paying $3,000 to $4,000 a year for heating oil. Some of the savings helps pay for higher electric bills. Some covers the monthly payments for the new system. The rest lands right in their pockets. A new furnace would have cost $6,000, maybe $7,000. Instead, Meyer paid about $20,000 for heat, air conditioning, and 2 new hot water tanks, a lot less than she was quoted the year before.
It was $37,000. It was too expensive.
The price dropped when Becky Meyer became Dandelion Energy's customer #1.
The experience of having geothermal, very good. The process of getting it, not as good.
Kathy Hanoun's company aims to cut the cost of that process, which involves drilling hundreds of feet down to install a narrow, U-shaped pipe. Water travels underground through the pipe where temperatures stay between 50 and 60 degrees. That 50-degree-ish water is piped back up to a heat pump, which uses vapor compression to take the heat from the water, then heats it further, and then pushes hot air out to heat the house in winter.
Yeah, you can feel the heat.
When it's hot outside, the system reverses, taking hot air from the house and cooling it in the pump. The technology isn't new. It dates back some 70 years, but Dandelion's prices are new. Before Dandelion, Hanoun worked at Alphabet's R&D arm, X, developing a product that converts seawater to fuel. That project ended when X couldn't find a commercial market for it. With geothermal, Hanoun sees a market and says the sky's the limit.
Just people using fuel oil in the Northeast are spending tens of billions of dollars per year just buying fuel. You have to make it worth people's while.
Dandelion's pitch? New systems for no money down. The company negotiated bulk rates with a contractor to do 20 installs in upstate New York last summer. Dandelion pays the contractor, and homeowners pay Dandelion $140 to $200 a month over 20 years.
Allowing a homeowner to switch without spending any money and save money immediately, that just really changes the game for a lot of people.
To change the game, Dandelion is partnering with contractors, hoping to do 200 installs this year for roughly $25,000 each. Contractors using Dandelion software can do estimates in minutes instead of hours, and Dandelion developed a narrower, lighter drilling rig to fit into tight spaces. This year, Dandelion rolls out its own heat pumps. The company says its waiting list has thousands of potential customers in all 50 states, allowing Hanoun to dream that Dandelion systems might someday spread like dandelions.
We intend to expand from homes to service buildings like schools and commercial buildings and military bases. I mean, really, the possibilities are endless.
And according to the American Council on Renewable Energy, 41 states have rebate programs that include geothermal heat pumps.
Before we go, here's a look at another look at the sell-off on Wall Street for you. The Dow plunged 665 points. The Nasdaq dropped 145. The S&P 500 dipped 59. We'll see what next week holds. That's it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Matheson. Thanks for me as well. Have a great weekend, everybody. We'll see you back here if you're brave enough on Monday.